Did you all sign the income book? Yes, I know it's a little bit out of the way today. What we might do is just keep passing it round. Maybe that's what we'll do. I haven't anything so yet, so I'll give to Right, now what I might do is I'll just get your email address.
Sure.
And I'll just email you the invoice and you can
oh, yeah, okay, like. Yeah, that's fine.
That might be the easiest.
My email is just
all
here.
Right, okay.
Yeah.
Good. Oh.
And then you should have all my details on that.
Right, let's put that in this folder here. Right.
Yeah, just don't forget to.
No, I won't. It's in this folder because this folder gets opened out as soon when I get back the next day. That's my processing folder.
Excellent. Thank you very much. And your name was
Cherry.
Cherry. Okay.
Yes.
Nice to meet
you.
Thank you.
All right.
So is that big coffee machine turned on yet? Or
it's for the break.
It's for the break.
Yes.
Can't have it
Yes.
earlier? No? That's
Yeah.
okay. So they just say no.
Yeah. Because they expect people to drink their water, I suppose. I don't know. So we might sort of start preparing to go live. I'll just start getting the mic off. Take it off mute. And you can do a test if you like.
We're going to start.
Yes.
Testing 1, 2, 3. Testing.
It's not working. Is that mask working? Just check that.
Testing 1, 2, 3. Testing.
Okay, I'll go up the back now. When you're ready. Maybe you could ask the attendee, there's one attendee on already. If you can just ask her if she can hear you, to say in the question, to flick on the question bar and say yes, I can hear you.
One of these guys? Or?
No, in the webinar. There's
Okay.
Julie's about the webinar.
Okay. So
She's already logged on.
You'll need to see that at your screen.
Yes. Yes. So
Or do you want to do that in the introduction?
I'll give you the thumbs up.
Okay. Say welcome to those present and those on webinar.
Yes.
Sure, turn my phone off. When the presenter leaves his phone. It's happened before.
Many times.
On the leg of the table.
Right. How's the time for?
Barely.
Sounds working well through the room, so I think we'll just go 4 o'clock.
Lovely.
Would you like to? Yeah, so just sort of you stand right near the microphone.
It's 4 o'clock.
One more coming here.
Okay, dictate.
One more coming in now.
Afternoon, everyone. Afternoon, everyone. Welcome to our second seminar for the CPC program for 2015. Before I formally welcome Nick Setchell, I would like to take the opportunity to congratulate all of our members that have achieved the CPC status. This is a sign of your commitment to continued learning and the development of our profession. Your AIC committee is working hard to promote your CPC status by a series of radio and TV ads that are designed to educate the public that there is a difference between conveyancers and conveyancers who are CPC certified. Keep an eye and an ear out for these ads shortly. We are also working to bring to our members a mini conference in August and ask that you save the date, which is the 15th of August, so you can attend. The conference will be held on a Saturday and will finish hopefully with a sunset cruise on the harbour. The conference will be based around e-conveyancing, verification of identity and other topical issues. Finally, we are hoping to launch our brand new website on the 1st of April. Auspicious date for some people, but not for us apparently. We will email you with notification of the launch so you can take the opportunity to see what information is available to you and available to the public. For those of you who have earned your CPC status, could you please remain after the seminar to receive your stickers for display in your office windows. Just a little housekeeping, we'll be having a 10-minute break at about 5:10. And we would appreciate your prompt return to the room as our remote participants will be waiting online for the seminar to recommence. Thanks for your consideration by doing this. Now for this afternoon's seminar. Nick Setchell is an accountant turned entrepreneur who realised that traditional accounting fails to provide the financial information that matters most to mid-market CEOs. Nick Setchell is a Fellow of the Australian Institute of Company Directors, Chairman of the Institute of Chartered Accountants, and professional with the National Speakers Association of Australia. He has presented numerous seminars on business improvement and has spoken to forums including the Vistage International Convention, ICAA Business Forum Connection, and the CEO Institute, and has consistently received the highest praise. Nick's career has predominantly been spent in executive positions, managing many different industries, so now he is here to give us a plain English view of the financial figures in our businesses. Please welcome Nick Setchell.
Thank you, Kristen, and good afternoon, everybody. So this afternoon's presentation is very much focused on helping you understand the numbers that matter in terms of running a business. This will come as a horrendous shock to some people, perhaps, because even though I started my career in accounting, I have a very strong, the vast majority of information used by accountants not understood. And that creates a lot of confusion. So one of the things we're going to try and do today is break down some of that confusion and help you to understand a small set of numbers where your business is working well, what you can do to create more value. So in terms of today's workshop, a little bit about my background to kick off with, then we'll go into fiscal focus, which is plain English numbers. What I'd then like to talk about is a concept called J-curves, and this is very much about if you choose to make a strategic investment in your business, how you then track that investment through your business to make sure you get rewarded as opposed to letting things drop through the cracks. And then we're going to look a little bit about some of the things that you can potentially change in your business to make it more valuable. So, in terms of my background, I did my undergraduate qualification a very long time ago, graduating with a Bachelor of Economics. Actually, I graduated with exactly the same degree that all graduates have, which is analysis. I was convinced when I came out of university that I knew everything. I was so convinced I knew everything that I was fortunate enough to get allocated or win a position with one of the big accounting firms. And that was quite a shock to the system because I pretty quickly worked out I didn't know anything. I didn't stay in the accounting profession very long. Very quickly, I got headhunted to run the software company. And it was somewhat of a shock because I didn't know anything about companies, I didn't know anything about software. So I'm not quite sure why I was doing that job, but I gritted my teeth and I was determined that that business was going to be successful. And the first thing that I learned when I took that role is in the IT area, in the software area. Here is a profession with Java. Does anyone here have anything to do with the IT? It is a profession riddled with Java, TLAs, SLAs, your TLAs, three-letter extended four-letter, and frankly, I had no idea what they were talking about. I actually felt really stupid. No idea what they were talking about. So I introduced a role into that business, which, as it turns out, was the luckiest thing I've ever done in my career. I introduced a role that if anyone wanted to bring an issue to the table to be discussed, they had to break it down to plain English. If they didn't, I didn't understand what they were talking about. But what I very quickly worked out is it wasn't just me that misunderstood what was going on. Nobody else understood. So they're all desperate to make sure So I introduced plain English into IT. Shortly after that, I realised that most people had no idea what accountants were talking about. And most people still don't know what they're talking about. So we introduced plain English numbers to run the business. And we went on with this thing of plain English. I'll share some of that with you today. After doing this for about a part of 6 years, I then got headhunted to do what today would be called turnaround consulting. I was about with a single phase to turn it around and send it in the right direction. Now, if any of you have ever witnessed a business that's at that level of pressure, you will know, as I know, that there are only two things in business that matter. Everything else is secondary. Those two things in business are people and cash flow. If you don't get on top of those two things, particularly in turnaround consulting, within the first 4 weeks, you're not coming back for a second month. People and cash flow. Within your own business, you have to be very clear on how strong is your cash flow, where are you at with your people. And I'll share with you this afternoon some tools for that. Having done this for the better part of 39 years, I decided it was time to start my own business. Sharing with other businesses around the world the ideas that I've developed to make those businesses more secure. Now, whether those ideas were developed in a consulting environment or in business was going to broke or otherwise, I have designed a series of plain English tools to help business owners run a more effective business. And some of those I'm going to share with you today. This has been a lot of fun, by the way. Our business is based here in Australia, but more than 50% of our revenue comes from overseas. We have clients all over the world that use the process. So let's talk about the very first module that we designed in the suite that's called Real-Time CEO. And that module is Fiscal Focus, plain English numbers to help people who have the responsibility of running a business but have had no financial training, which is most business owners, to help them run their business. Now let's look at a quote first of all. Albert Einstein. Everything that can be counted does not necessarily count. Everything that counts cannot necessarily be counted. Very clever words, but what Einstein was basically saying to us is most of the information produced by the accounting fraternity is double. Now, to complement that, I found this quote here, and you can just hear how English is over the You can just hear how English this chap is. You're right, Jenkins, the numbers don't lie. There's me some that do. So the reality is that numbers are the language of things, and you will have to learn to speak that language. If you want to be effective at running a business, you'll have to learn to speak that language. Does that mean you'll have to go out and grow yourself an accountant? Absolutely not, because the numbers they use are not the ones we're going to talk about this afternoon. So, in all of the processes that we developed, we didn't just leap in and come up with something different. We did a significant amount of research to try and work out why the incumbent or the normal mechanism didn't work, and then we came up with an alternative. So I'm sure you've all heard of the concept of double entry bookkeeping. That's what accountants have been using for almost 900 years to measure business. Now, some of you in the room may know what I'm about to say to be correct, others may be surprised. But there are some very exciting things about bookkeeping. Now, as it turns out, I have picked me up our second for skepticism. As though you don't believe me. So allow me to share with you one of the riveting things about bookkeeping. Bookkeeping is the only word in the entire English language with 3 double letters in a row. Have a look at it. Double O, double K, double E. If you learn nothing else this afternoon, but this golden nugget, it will have been worth coming along. Now, beyond that, nothing particularly exciting about bookkeeping. The problem is that the accounting profession has been using bookkeeping for centuries to measure business. The second problem is that it was never designed to help us manage business. So
Just
what
see
does
if it's going to come up.
Produce? In essence,
I'm going to send you another link.
documents. I'm sure it's on stage in your life. You've seen income statement and a balance sheet.
As a
One of these two documents is very easy to understand, the other isn't. The income statement is relatively easy to understand. You don't need to be trained as an accountant. You have revenue at the top of the page, you have expenses underneath. I'll give you a tip early on in the afternoon about running a good business. Make your revenue high your expenses. That will be a good start. It's not actually everything, it's actually the start.
I'm just going
The
to
second document, quite frankly, is totally confusing.
now.
And what that means is that most people, when they're judging their business, will judge their business on two. And judge the number at the top, and the number at the bottom, and the number at the bottom, and understand. Revenue, and they will say something along the lines of, my business is stronger because my revenue is higher this year than last year. Because they haven't really got any other. Now, while revenue really doesn't tell us much about the real estate business. Profit is a little bit more
Yes.
important, but it's only half the picture. So if we want to get a real business, we can't use
when you
this
get
all
this
together. We've got to use this combination of two, which is where the problem starts, because most people don't
just
understand
don't
stuff.
touch it.
One of the things we're going to do is
You know, just
break
join in
this
everything,
down
but
into simple
don't
terms
use
to
that
understand.
bar on the right hand side. I'm
So
just
revenue and profit are the numbers that people normally use to assess health in business.
Well,
This
it
one
says
is
it's
another
set.
hard thing I found. And clearly you can see if you work in a small business, as indeed I do, that the entire concept of taking vacations out of the question.
From this problems, I'll just
But in
get them to do
essence,
the
what
panel.
fiscal focus is designed to do is to go a little bit further than just
I'll
look
give
at
you a call
revenue
back
and
in
profit,
about 5
and
minutes.
actually
Have you
assess
emailed
whether
yet?
the business is in good shape.
Okay, all right, well, I'll just stay with you.
Another person coming along.
She just doesn't recognize.
Now just close out.
So
that
come on
other
in.
thing.
If you're a conveyancer, come on in. If you're not, you're in the wrong place.
Not in, I'm just
You
saying.
are. Those are already over here. Come and sit down. They just started, so that's fine. In essence, what fiscal focus is designed to do is to translate the language spoken by accountants, which is, of course, accountanese. Nobody will speak.
Yes.
It breaks away from a concept called gap. Does anyone
That'll give
understand?
you
Anyone
the direct link rather than through the
generally
through
accepted
the recorded
accounting
feed.
practices? It is the format of accounting that is used around the world. That accountants actually have to use. The government says you have to do it that way, which is fine, except that I don't understand. And by restricting ourselves to gap accounting, it's very hard to know what's happening in the business.
It's got a double name.
You've got only one though. If it's only a third, it's going to bookkeeping quite clearly.
All right.
Now, what fiscal focus is designed to do is to, first of all, table numbers that are relevant, but more importantly, generate conversations.
Hello, this is Cherry.
Every single calculation you do with fiscal focus is for one reason alone. Generate a conversation that's going to result in an action, whatever the action happens to be,
Yeah.
that's going to make the
Well, what I'm going to do, I'm just going to send you an email.
So, one of the things that we have to do if we want to understand the true operational performance of our business is to break away from the constraints of gap accounting. Let me just take you through how we do that. We're going to do it for two
all
levels,
right.
the income
Now,
statement
just
and the
going
balance
to
sheet.
get
So
to
here is a traditional income statement. Revenue less cost of goods sold equals gross profit less overheads equals net profit. I'm sure you've all seen a P&L that looks like that. In transferring or breaking that away from gap accounting into operational format, they're actually going to look fairly similar. We're going to have revenue at the top, operating revenue at the top. Let's what are called direct costs. In your environment, your direct costs are the costs of the people doing the work. How you define direct versus indirect is absolutely up to you. But my advice to you is keep it simple. I would have all of your salaries as direct costs and everything else is indirect. That brings us down to a number called contribution margin. We then take off our indirect costs, so rent, petrol, cars, whatever else is a cost to run your business, to bring us to a measure called real operating profit. Now, in public companies, when you hear a report in the financial press about public companies, they tell you how much profit they've produced in a public company. Have you all heard the expression EBIT? EBIT is public company operating profit. It stands for earnings before interest and tax. So if we want to get a true measure of real operating profit in our business, we have to do it before interest. In public companies, interest is listed at the bottom of the page after EBIT because it's a cost of funding. Where do we typically see interest listed in a GAAP P&L? I'll tell you, wedged between internet costs and insurance. Anyone want to hazard a guess why interest is wedged between internet and insurance? That's right, alphabet. What a very clever way to sort numbers. Let's use the alphabet to sort numbers. Really? I think we can do better than that. Now, the other thing that you will have to keep an eye out for is the concept of how we deal with owners' salaries. How many people in this room own the business that they run? Now, when you own the business that you run, you can pay yourself whatever you want. Within the realms of cash flow, pay yourself whatever you want. I don't care. But if you want to get a true perspective of how much profit your business is actually making, then you need to go through a process called normalisation of owner's allowance. It's actually very simple to do. Ask yourself the question, if I was paying somebody else to do my job, how much would I have to pay? It's not the question how much do you pay yourself, that can be whatever you want. It's how much would you have to pay somebody else to do the job. So hands up who was owned the business they worked for? Your name or sorry? Lorraine. Lorraine, I'm not going to ask you the question, the embarrassing question, how much do you pay yourself, because that's your business. But how much, if you had to get somebody else to do your job, how much would you have to pay them to do?
150,000.
There is a vote of confidence in the room, Lorraine. Let's go with 150,000. That could be on the high side, but anyway, shall we say 100? Shall we say around 100,000 because you've got somebody to do your job. So whatever you're paying yourself, they can adjust it. Let's say hypothetically you pay some 120,000, which is your right if you own a business. If we were calculating your real operating profit, we'd leave 100,000 up in costs, because that's the cost of the job. We'd put the other 20 down into distributions, because that's what they are. You're right as the owner to take an extra 20. And you calculate the real profit based on 100, which is the commercial value of the salary. Is that clear to everyone? So that's actually very important for you to truly understand what your real operating profit is. Okay, now this transition is actually pretty straightforward. And the reason it's straightforward is, first of all, you understand the P&L, everybody does, and secondly, the adjustments are pretty minor. This transition, however, in the balance sheet is a little bit more involved, but it's really useful. Now, can I credit that pretty well everything you see this afternoon has been my research, with the exception of what we're going to see at the bottom of this screen here. I didn't come up with this idea to restate the balance sheet. This was in fact first invented over 90 years ago by a company called the DuPont Company. Have you all heard of the DuPont Company? These guys are engineers. And what was happening in the DuPont Company 90 years ago is that the accountants would walk into the management meeting with two documents, P&L and balance sheet, like they do today. So there you go, guys, there are your documents, see you later. That's what you need to know about your business, see you later. Engineers would pick up the income statement and read it, because they could. Revenue up, expenses under control, profit up, must be doing a good job, because that's what we all do. Then they pick up the balance sheet, they go, no idea what this is telling me. So push it to the side, much the same as we do today. Now one day, one of those engineers asked a breakthrough question. Put his hand up and he said, I know this is going to make me sound stupid, but I've got to be honest, I don't really understand. I think it's important because you keep giving it to me, but I don't understand. So if there's anything important on this second document, could you please tell me in my language, not yours? That was a pretty clever question. What happened was the engineers took away the accountants and they forced them to explain every single element of the balance sheet in plain English. Started at the top of the assets are the things you own, and the first line on the balance sheet was debtors. You've all heard of debtors, haven't you? Although the amount of time we spend trying to work out the difference between debtors and creditors, and do we have to pay them or are we getting paid? It's just doesn't head, really, doesn't it? This is one area, I've got to tell you, where the Americans get things right. And I actually don't say that very often. Sorry, do we have any American people before I say anything else about the Americans? They don't use the word debtors and creditors because no one knows what they mean. They use the words accounts receivable, accounts payable. You're either going to receive the money or pay the money. Quite simple. Anyway, so the engineers sat the accountants down and said, what's this thing, debtors? Oh, that's where people owe us money. We've done a service, but they haven't paid us yet. They're going to pay us in the future. It's like an IOU. Okay, I understand that. It's plain English. Move on. And they went through the entire balance sheet, explaining it. Now, the engineers were smart cookies, and what they very quickly learned was that while accountants were expressing the balance sheet as a numerical document, pluses, minuses, difference, what the balance sheet also told us was how the business was funded and how the funding was being used to run the business. How it was funded and what the funding was being used for. So they basically recast the balance sheet into a functional document. Funding on one side, operational components on the other. Now, there are only two ways you can fund your business. Would anyone like to hazard a guess what those two ways might be? In plain English, so keep this simple. I don't want any jargon at this stage. Very simple. Two ways to fund your business are?
Loans and yourself.
Not bad. That must be why you're president. Not bad. Your own money, somebody else's money. Those are the only two options you've got. Your own money, somebody else's money. Although I have to very quickly tell you an anecdote. I was giving this presentation in Dublin, in Ireland. What are you Irish people? What I'm about to tell you will give you a very clear insight to the state of the Irish economy at the moment. So I'm giving this presentation in Dublin, in Ireland, and I'm explaining that there are only two ways to fund a business, your own money and somebody else's money. And up pipes one of the audience and said, actually, Nick, we've got a third way of funding a business here in Ireland. It's called the promissory note. You borrow money and you don't have to pay it back. Yeah, sincere apologies for my woeful Irish accent. But I think if they think that's a way of funding a business, that gives us insight to why their economy is in the stripe it is. There are only two ways to fund a business, your money and somebody else's. On an accountant's balance sheet, they'll be called equity and debt. Equity and debt. This is what I referred to anecdotally as the pot of gold. When you decided to set up your business, you as the owner, well before you became the manager or the operator, you as the owner decided how much of your money you were going to use and how much of the bank's money you were going to use. And I want you to imagine that you filled up a pot with the money that was needed to start this business. I'm going to call that pot of gold. What I now want you to do, because I know most of the people in this room are not only the owner, but they're also the chief operator. I want you to understand you've got two hats on. You've got the owner's hat on, and you've got the chief operator's hat. The owner decided between debt and equity, or their own money and somebody else's money. Now I want the chief operator to imagine that the owner's given them that gold and said, right, there's the funding for the business. Now start running the business, and I'm going to judge you on how well you create return for my investment. Fair comment? You invest in houses, you invest in property, you invest in shares, you also invest in your business. You've invested a pot of gold in the business, what return are you getting? And that's going to be determined by how well you use the other things that are sitting on the balance sheet. Accounts receivable, we all know what they are. That's where we've raised an invoice to a customer and they've not paid us yet. In your language, that's the time between finishing the job and the property settling and you getting your money. So you've all got accounts receivable, haven't you? Inventory. Most of you probably think you haven't got inventory in your business because it doesn't appear as a number anywhere on your balance sheet. But believe me, you've got inventory. You've done a significant amount of hours of work for people who are going to pay you in the future if everything goes right. Let's call it work in progress. So you might be 3/4 of the way through a settlement and you've done most of the hard work, you just haven't raised the invoice. So yes, that's the inventory of your business, is the work you've done leading towards a invoice. Fixed assets. What fixed assets do your businesses have? Somebody tell me a fixed asset that your business has. Computers, very good. What else? Photocopiers, yep. Cars, IT equipment, phones, furniture, they're tools of trade. You've all got fixed asset investments in your business. Accounts payable. Jacuzzi, yes, absolute jacuzzi. Seriously, if you don't have one of those in each office, it's just not a fun place to work. Anyway, maybe you should come and work where you work. There you go. Accounts payable. Accounts payable. Can somebody give me an example of how your business might have an accounts payable? You owe somebody for something. What might have occurred for that to happen? Yes, rent is a good example. What about if you'd asked for an inspection to be done and you still hadn't paid for the inspection and you had that invoice sent to you and you owed the money? So that's an accounts payable, isn't it? Okay, this side is the pot of gold. This side is how we use that pot of gold to buy fixed assets, to fund receivables, all of those type of things. Now, does everybody understand that conceptually? I'm going to go through it again numerically, but you all understand it conceptually to kick off. So, let's do exactly the same thing with an actual balance sheet numerically. And let's do it to answer the key question, how much money is invested in your business? If I asked you all to tell me how much is invested in your business, many of you would not be able to answer that question, which is not your fault, by the way. It's actually the accounting profession's fault, but let's leave that aside for a second. I do, however, find it quite interesting when I ask an entrepreneur, how much is your house worth? They can tell me to within normally 100 grand. You guys are getting close. I'm not asking how much was it worth 40 years ago, I'm asking how much it's worth now. If I say, how much money have you got in your share portfolio, I bet you could all tell me to within 20 or 30 grand. But when I ask you how much is invested in business, you don't know. Which is unusual, because you could very easily have more invested in your business than in your house or your share portfolio. And your day-to-day actions are determining how good the return is. So I suggest you find out how much is invested in your business. So I'll take you through exactly how we do it. Now, here is a traditional balance sheet. I'm sure you've all seen something like this. The things that we own at the top, the assets, the things we owe in the middle, or the liabilities, and the difference, which is our equity at the bottom. You've all seen something like that? Now, if I challenged you all to say how much is invested in that business, you would struggle to answer the question. By the way, if you're an accountant, you'd struggle. In fact, I love, do we have any accountants in the audience? Because if we do, you're going to have a shocking I like challenging accountants to say, there's one of your balance sheets, now tell me how much is invested. They can't do it, because they don't even know why I'm asking the question. They say, that's the only way a balance sheet should be done, it's written. We have to follow that rule. Well, the reason you can't tell me is it was never designed to tell you. So let's use this new DuPont method, and let's push this balance sheet around to answer the question, how much is invested in this business? I'm going to go from the bottom of the page. In fact, you're going to do it. That's how easy this is going to be. And we're going to put either an F or an O for funding or operating next to each of these issues. Now, we'll start at the bottom to keep it simple. Do you all understand equity is your money? So are you all happy for us to put Fs next to retained earnings and share capital? Good. Next one, miscellaneous operating liabilities. I'll give you a hint. There's a hint in the title. Miscellaneous operating liabilities, F or O? Oh, very good. Long-term debt, what's that? Funding, that's right. You owe that to the bank, don't you? So funding. Lease payables. Now, sometimes there'll be some confusion. This is not the asset that you bought with the lease. This is not the photocopy you bought with the lease. That's going to sit in your fixed assets. This is the debt you owe to the HP company or the lease company. So it's just another form of funding, correct? You could just as easily go to the bank and borrow the money off you bought the photocopier, correct? So you're happy for that to be funded. Trade payables, that's accounts payable that we talked about earlier. So what's that? Operating, good. Line of credit, funding, good. Miscellaneous operating assets, operating. Fixed assets, operating. No, that's your tools of trade, isn't it? You use some money to go and buy a car. Inventory, operating. Receivables, operating. Now, if there's going to be any confusion in the DuPont way of restating a balance sheet, this is where it's going to be. How do we deal with cash? I'm going to tell you how they deal with it. I'm going to try and explain why, but it's just one of those things you've got to kind of take on face value. By the way, the bank uses exactly the same way of looking at cash. And the bank and the DuPont mechanism treat cash as the opposite of debt. Think about what they're doing here. Imagine if you had two bank accounts. One that you owed the bank $100,000 and another one you had $30,000 of your money. Conceptually, you could pick up that 30 grand and pay off some debt, couldn't you? Leaving you with 70,000 of debt. What the DuPont group says is, even if you didn't choose to do that, the net is still 70. So what we're going to say is the debt is 100k of debt, cash is minus 30 of debt, debt 70. Really okay with that? Good. So now that we've done the hard work, and that really wasn't that hard, let's join together all of the funding to answer the first question, how much is invested in the business? So let's bring together all the F's, cash, line of credit, lease payables, long-term debt, share capital, retained earnings, and it totals $795,000. The answer to the question, how much is invested in this business, is $795,000. And you had no way of getting to it here, but now we do. And not only do we know that it's $795,000. But we also know that most of it was lent to us from the bank and a little bit of it's ours. So that's the owner hat saying a bit of it's ours, most of it's the bank's.
How come the cash is negative?
Cash is treated as negative debt. So remember that concept that if you've got two bank accounts, sorry, that was your question? In one bank account you've got $100,000 of debt, and in another bank account you've got $30,000 of cash. You could conceptually take that cash and pay off some debt. In this example, we could take that cash and pay off some line of credit, correct? But because it's listed as debt, that's negative, that's positive. Okay, now if this thing's going to work, the balance sheet still has to balance. Dead giveaway in the title, really. Balance sheet. It needs to balance. So if this thing's going to work, we need to make sure that the sum of the other components, operating assets, 1115, minus the operating liabilities, 320, equals 795, and it does. Everything that was on the balance sheet before is still on the balance sheet now. But now what we know, which we didn't know here, is that $795,000 is invested, and this is how we're using it. Most of it is receivables and inventory, a little bit of fixed assets, and our supply chain, we owe our supply chain $300,000. Now, one of the things that the DuPont balance sheet then enables us to do is to say, hang on a second, on this entire complicated document, there's only 4 things we have to pay attention to. Accounts receivable, how well are you collecting money from your customers? Inventory, how efficiently are you doing your settlements? How quickly do you go from starting work to finishing work and raising an invoice? Fixed assets, how many cars, jacuzzis, photocopiers have you got, and how well are you using them? And accounts payable, how quickly do you pay the people who provide you with services? And if you're paying attention to those 4 things, believe me, as well as your revenue and your expense, which you are because you understand that, you never need to fear the balance sheet again. It's just become a simple document, not a complicated document. Pretty well every public company in the world now uses the DuPont balance sheet for internal purposes. They're not allowed to use it for external purposes because the law says they've got to use GAAP accounting. But for internal, for helping everyone understand what's going on, that's what they use. That makes sense, right? We all now promise that we'll never ever be scared of a balance sheet again. They're just 4 numbers. Okay, good. So, if we start talking about running a good business, which is why you're all here, you're here to learn about what numbers you should be using to assess whether you're running a good business and what actions you can take to run a better business, then the first thing that we want to say is good business is all about good investment, correct? Your clients understand it, you understand it. If you want to understand whether you're making a good investment, you absolutely need to answer the question we just asked. How much is invested in my business? I want you to go home, not necessarily tonight, but sometime in the next couple of days, while this is still fresh in your mind, take out your balance sheet and recast it as a DuPont balance sheet so you know how much the pot of gold is that you have invested in your business. Now, once you know how much the pot of gold is, a couple of other questions. For each dollar invested in your business, how much revenue could you leverage? This is a pure quantity of revenue measure. Nothing to do with quality at this stage, just how much revenue could we leverage? And then, of course, I want you to answer the question, how profitable is your revenue once you've earned revenue? Quantity and quality, those 2 things are going to come together to be key determinants of the health of our business. And once we can answer these 3 questions, we are then, and only then, in the position to answer the real questions that every entrepreneur should ask about every investment, and that is, am I making a sufficient return on the investment, given the risks that I'm taking? And just as importantly, have I generated sufficient cash flow in this business to be able to be an entrepreneur tomorrow? You guys get return. Every time you help somebody buy a property, if they're buying it for investment purposes, you understand they're buying it to get a return, correct? So you understand it for your clients. All you've got to do is understand it for yourself. You've invested some money in your business. Are you getting a fair return for the risks that you're taking? And just to be quite clear, every single day you go to work, every single day you choose to run your own business, you're taking a risk. the risk that someone won't pay you, the risk that somebody will do the wrong thing. There are lots of risks associated with running business, so you deserve, if you're going to take that risk, to get a return. Okay, good time to introduce the fiscal focus pyramid. So let's take these concepts, these two concepts of return and cash flow, the two most important numbers to assess the health of business, and let's put it at the top of the fiscal focus pyramid. And may I please observe that the two most important numbers to determine health in business do not appear on either a P&L or a balance sheet. The two most important numbers you need to know to understand your business. Accounting has failed to deliver to you. They sit between the two. They are, in fact, hidden. And quite frankly, if you don't understand the second document, how are you ever going to understand the hidden numbers in between? It's just not there. Not your fault, it's the accounting profession's fault. Are you starting to see why accountants love this session so much? Sitting underneath these two fiscal focus points are 4 fiscal focus measures. These are 4 numbers that we've been working on now for 14 years to assess the strengths and weaknesses of just about any business in the world, regardless of industry, size, location, you name it. And I'll be talking about what these measures mean as I go through the rest of the session. And then underneath are what we call the levers. These are the things you can change. Please do not overcomplicate business. There are only 8 things you can do to change a business, any business. Okay, whether it's BHP or you guys, there are only 8 things you can do. Let's have a look at the ones on the right first. You could change how much you charge your services, how much you charge per conveyancing service. We're going to talk about that one later. Your costs, some of them will be direct, some of them will be indirect. Don't get hung up on that. Keep it simple. Your direct costs are you and your staff. Your indirect costs is everything else. Rent, petrol, butter, coffee, paper, all of that stuff. You could change the volume that you do, how many services you offer per year. Subject to the market allowing you, you could work a bit harder and just do a few more. There are 2 ways that you can change revenue. You can charge more per service, or you can do more services, or a combination of the 2. You could collect your revenue a little faster from your customers. Frankly, that might be difficult in your industry if that's an arrangement that you get paid when it settles. Inventory management. You could do the service more efficiently, so there's less time between you starting and you finishing. Now, sometimes you're in control of all of that, sometimes you're not. You know as well as I do how frustrating it is when you get held up because of things out of your control. But at any rate, that influences your work in progress. You can influence how long it takes you to pay for the services that you've bought in, and you can use your fixed assets more efficiently. Those are the 8 things that we can do to change business. You're going to see later on in the second segment after our break that we're going to apply a process called sensitivity analysis across all 8 to tell you which change will have the most profound impact for creating increase in return. And that, of course, is going to result in numbers that turn into conversations, that turn into actions in business. That is the fiscal focus pyramid that we've designed here in Australia, that we now use for businesses all over the world. Level of business is today can be stronger tomorrow if you follow this type of assessment. So, cash flow. Now, Sherry, something's just occurred to me, and I should have thought about this earlier on. Flip chart or whiteboard. Do we by any chance have one? If we don't, it doesn't matter, we'll just make do. Fantastic, thank you. I should have thought about that earlier, but I was so excited about everything else that was going on, I forgot. Okay, so there are lots of different ways to measure cash flow. And that's really annoying, isn't it? Why can't they just come up with one way to measure cash flow? Well, actually, depending on who you are, you measure it differently. Banks measure it differently from accountants, measure it differently from investment, markets, valuers. Everyone measures cash flow differently. But when we were building Fiscal Focus, what we wanted was a measure of cash flow that reflected operational reality. So I'd like to take you through this measure of cash flow. And actually, while the flip chart is coming, if it's coming imminently will be okay. If not, what I'm going to get you to all do is take out a piece of paper. You've all got a pad in front of you. And what I would like to do, as we go through the measure of cash flow, I want you to replicate on your piece of paper in front of you what the P&L of this example business would look like. And the reason, I'll tell you exactly what you need to write down and how we're going to construct the P&L, but the reason I want you to do this is I want you to be very, very clear on the fact that measuring and judging a business based on the P&L, which is what most people do, is actually quite dangerous. You need to be judging your business based on cash flow. Why? Because cash flow is reality. Here are some quotes that I'd like to share with you. 3 different things to help us understand that cash flow is critically important. Does anyone in this room not think cash flow is important, by the way? You're all absolutely clear that it's the lifeblood of business owner. Some people say to me, oh yeah, it's reasonably important, but profit's really important. No! Profit is like food, for sure. Yes, we want to make a profit, but believe me, cash flow is like oxygen. Terry, if we can't find one, doesn't matter. Imminent. Fantastic. I love that word. Second, have you ever heard this expression? Revenue is for vanity, profit is for sanity, but cash flow is reality. You can make yourself feel a lot better by creating a bigger business. Go down to the pub and tell all your mates you're running a bigger business. But by the way, if you're not turning it into profit and cash flow, waste of time. And here is one through the eyes of a banker. Profit is an opinion. Cash flow is reality. You can actually make your profit and say anything you want by passing accounting journal entries. How much cash you got in the bank, you can't fake that. So cash flow is it, isn't it? So let's make absolutely sure that we all know how to measure cash flow. Okay, I'm going to take you through a simple cash flow calculation. And as I do, what I want you to do is to write down in the margin what this business's P&L would look like if this was their cash flow statement. So we're going to start at the top of the page with revenue. So put a big thing next to it saying P&L and write revenue $15 million. Whether your revenue is $15 million or not is irrelevant. For this particular example business, their revenue is $15 million. And the very first thing that the bank is going to do, because this is, by the way a banker calculates cash flow, the very first thing that a bank is going to do is to say, sure, your P&L is saying that you made $15 million of revenue, but what happened to your receivables? How much of it did you collect? Because, by the way, if you haven't collected it, it's not in your bank account, it's still in the customer's bank account. So for this one, their receivables were $1.2 million higher at the end of the year than the beginning of the year. So this document, by the way, is calculated across a 12-month period. Revenue for the 12-month period is $15 million. The receivables, which is a fixed number at a point in time, is $1.2 million higher at the end than the beginning. In other words, the business is probably growing. That's one reason why receivables go up, correct? Now, if your receivables are $1.2 million higher at the end of the year than the beginning of the year, and your invoicing was $15 million, how much money have you actually collected? 13.8, correct. Because the other 1.2 is still sitting in your customer's bank account. You will hopefully collect it at some stage in the future, but you haven't yet, okay? Next line, direct costs, 10.5. So in your P&L, can you write under revenue, direct costs, $10.5 million. And then put a line underneath that, contribution margin 15 million minus 10.5, 4.5 million. So that's what your P&L is looking like at this stage. Has everyone got that down? 15 minus 2.5, 4.5 million. 15 minus 10.5, 4.5 million. Everyone okay with that? Now, what's the bank going to do to direct costs? Well, the first thing they're going to say is, well, have you built up inventory? Have you built up inventory? And if you have built up inventory, well, guess what? That had to be funded. So in other words, this particular business is holding $700,000 more inventory at the end of the year than it was at the beginning of the year. So that had to be bought, didn't it? But actually what also happened was that they were given $600,000 more credit by their suppliers. So they actually only had to fund the difference of $100,000 plus the 10.5 million of the direct costs, correct? 10.5 million plus 100,000, 10.6 million. Is everybody with me so far? 13.8 came in, 10.6 went out. You all okay? That 10.6, by the way, is very different from the 4.5 million you've all got written down, isn't it? So already we're seeing a big difference between our P&L and our cash flow statement. Where do we go next? Indirect costs, 3.6 million. Please all add an extra line to your P&L. Indirect costs, 3.6 million. And then write another line under that. Profit is going to be a contribution margin of 4.5 million minus our indirect cost of 3.6 million. How much? This is just testing the mathematical astuteness of everyone, or to see whether you're still awake. 900,000, correct. The profit of this business, the P&L that you have in front of you, is showing this business is earning $900,000. Now here's the thing. Do you reckon if you were running a $15 million business that made 900K of profit, you'd be pretty happy, wouldn't you? You'd be pretty happy. You'd be down the pub singing a few beers, I reckon. Because most people will judge their business based on revenue and profit. And they'd look at 15 million and they'd say, well, 15 is pretty good, especially as last year we were at 13 million. 900 is pretty good because last year we were at 600. And you'd look at that P&L and you'd say, I'm a hero, I'm doing a good job, correct? Well, just before you get too excited about that P&L, let's have a look at what's happening in your bank account. You have $3.2 million, but you've got $3.6 million of bills to pay. You have not got enough money to pay your bills. You are going broke. The P&L is telling you you're doing a spectacularly good job. Your cash flow is telling you you're going broke. Does everyone in this room know, without a shadow of doubt, that it is possible to be profitable and still go broke? You all understand that that's possible? Some of you are not so sure, right? You're sitting there going, what's he talking about? How can you be profitable and go broke? You can go profitable and go broke because you haven't collected all the money yet. You've had to pay out all the bills, but your customers haven't paid you. Then you get that nasty little call saying, I'm sorry, your customer's gone broke, they're not going to pay you. Hey, by the way, Pess, you still don't believe me. Over 80% of the businesses in Australia that go broke, over 80% of them go broke owing money to the ATO. Anyone has to guess why you owe money to the ATO? What have you done to owe money to the ATO? Oh, that's right, you've made a profit. You don't get taxed on profit, correct? So all of those businesses were profitable and they still went broke. This is how you're all judging your business on P&L, on revenue and profit. If there's nothing else you learn today but this, start judging it on cash flow. It's a very simple calculation. Do you all understand the mathematics of this calculation? Not complicated, is it? But very quickly you could take your P&L, add in the movement in your balance sheet, receivables, payables and the like to get to a cash flow calculation, and you are then going to have a better indication of your business's health. Everybody with me so far? Good. Let's turn our attention to the second of the fiscal focus points, which was a return calculation. And the calculation we use is a calculation called return on operations. Return on operations is our version, after 14 years of research, of a measure used by most public companies in the world called return on capital employed, or ROCE. ROCE is the most powerful single number to determine health in business. By the way, that's not my words. Those are the words of just about every public company in the world. Let's have a look at ExxonMobil, one of the biggest companies in the world today. They publicly publish that ROCE is the most powerful indicator of management performance. So here's an interesting observation. If public companies around the world understand that ROCE is the best number they have at their disposal, why don't private companies use it? And believe me, very few private companies do. Does anyone in this room calculate ROCE on their business? Nah, of course not. The reason that public companies don't is because they think it's too complicated. It doesn't have to be too complicated. So I want to take you through how we're going to calculate the equivalent of ROCE. We're going to call it ROE on your business. And at the end of today, you're going to be given a ready reckoner that you can pump some numbers in, your numbers, and it'll tell you what your return is. And then you can work out over future years whether your business is getting more valuable or less valuable. Believe me, if your return's going up, you're getting more value. So, let's have a look at it. What is ROE or ROCE in plain English? I want you to think about this as an interest rate. You guys understand interest rates better than most. If you put money into a term deposit, you earn interest, correct? If you put money into a rental property, you earn an interest rate, correct? So why not be thinking about your business as earning an interest for you, the owner? You've put money into the business. We've calculated how much. In our previous example, it was the 795. You should be able to say, I'm getting 20% return, or 30% return, or 40% return on that investment. And if you can do that calculation by the end of the day, you'll be able to. Do you understand that that will be the best indicator for cost from your business and what you should do to make your business stronger? Okay? So, if I asked you all to describe what an interest rate is, would it be fair to keep things very, very simple and say what you put in versus what you get out? Is that fair? Input versus output. Now, what are the numerics to do this calculation? Because it doesn't have to be complicated. The numeric for input is investment. That is the number we got to by recasting our balance sheet. You can't do this calculation using traditional accounting. You can only do it once you've recast your balance sheet. And we went through before how you do that. But once you know how much is invested in your business, you've got the input part of your return calculation, okay? What is your output? It is your real operating profit. It's not the number at the bottom of your P&L. It's the number at the bottom of your P&L once you've taken interest out, once you've normalised your owner's salaries. It's the real profit that your business earns before you start playing around with it with all these other accounting interests. Making sense? So, if all I wanted to do was to calculate ROE on a business, simple. Take the real operating profit, divide by the investment, multiply by 100, there's your interest rate. It's actually that simple, I promise you. But actually, I'd like to take it just one step further. You don't have to take it one step further, but go with me if you will. If I take it one step further, I can start to answer some really key questions in terms of not just how good is this business, but how can we make it better? Which is, of course, why what you should always be thinking. Whatever I am today, how can I be stronger tomorrow? So what I'm going to do is use some mathematics and insert an annual revenue top and bottom. Do you all remember back to high school mathematics? Top and the bottom, they cancel out. So that and that are the same, correct? Thing about this, though, is that this is going to enable us to loop right the way back to the questions we asked earlier on in the session. So let's have a look at what those questions were. Those questions were, for each dollar of investment, how much revenue can I generate? And how profitable is my revenue? They were the questions that we said we needed to ask and answer to determine whether we're running a good business. And now we can answer them numerically. Because revenue divided by investment tells us that. It's called your leverage rating. And it basically measures the quantity of revenue you can generate. This basically tells us how profitable you are. It's called your profitability, and it indicates to you the quality of your revenue. Now, once again, that's a conceptual slide. I'm going to do it again mathematically, but conceptually, do we understand what we're trying to do here? We're trying to answer two questions with some numbers. So let's now do it with numbers. I want you to imagine you put $1 into a business. I don't care whether it's $1 or 1,000 or whatever, but let's just do it on a single dollar. And ask the question, first of all, how many dollars of revenue could I generate each year based on my dollar of investment? We know that that's called the leverage rating. And we know, if we go back to the pyramid, if you go back to the pyramid in your notes, that 4 things influence the leverage rating. And they were the 4 operational elements of our balance sheet. How well we manage our accounts receivable, how well, in other words, collect money, how well you manage your inventory, in other words, how quickly you do what you do, how well you use your fixed assets, and how well you manage your supply chain. Let's assume in a hypothetical situation that a business's leverage rating was 3. $1 would become $3. Now I want you to ask the question, the profitability question, how profitable is my revenue? And there are going to be 4 things that influence that. And if you go back to the pyramid, you'll see the other 4 things are price, 2 costs, direct and indirect, and volume. Now let's imagine that in each dollar of revenue, you make 8 cents of profit. I'd love you guys to be making 8 cents of profit, even 9 or 10 would be even better, but let's just say 8 at this stage. In our $3 of revenue, do you then appreciate that we're making 24 cents of output, 3 times 8? What is 24 cents as an interest rate on the dollar that you invested? Pretty straightforward, isn't it? 24%, correct. Now, these are all calculations, but let's turn it into a conversation. Let's say that I'm talking to the owner of this business. The first thing I'm going to say is that the number in the middle is not influenced by whether you choose to be a conveyancer, a builder, a plumber, a lawyer, an accountant. Doesn't care what you choose to be. It's simply going to say if you put your dollar there, this is the return you get back, versus if you put your dollar there, that's the return. But what becomes interesting is the 2 numbers, the 2 white numbers, are heavily influenced by the industry you choose to be in. And I'll give you some targets for your industry shortly. But right now, if I was having this conversation with this particular business, I would say your input rating is 3. But we expected for your industry it to be 4. Therefore, I think this business has an input problem. If this business has an input problem, where do you think I'm going to go to find the problem, and therefore, by definition, the solution? I guarantee it is either there, or there. I guarantee it. Your output is 8, but I expected it to be 10. I think you have an output problem. Where do you think I'm going to go to find the problem, therefore the solution? I guarantee it is in the management of that, or that. Now, after the break, I'm going to introduce you to sensitivity analysis, which is going to be layered across all 8 of those levers to tell you which change would have the most profound impact on fixing the weakness and driving the value up. That is the formula to take any business in the world, any conveyancer practice, any business in the world, and make it more valuable tomorrow than it was today. Pretty exciting, isn't it? In fact, I can see the excitement just splattered all over your faces. Here is a formula to take any business and make it more valuable. Let me tell you what else is exciting about this. It works. We've now done this over 1,000 times for businesses all over the world. Designed here in Australia, done all over the world. It works. Very exciting. So when you judge your business, please don't judge it on the profit you make. That's only half the picture. Judge it on cash flow. That's a good idea. Judge it on return. That's a good idea. I've shown you how to calculate cash flow. I'm going to give you a calculator to calculate return, so you don't even have to do it. You just plug your numbers in and it does it for you. Judge your business on that, then you know whether you're doing a good job or not. Now, let's skip through this because I'm wanting to save time to talk about something else before we go to our break at about 10 past, quarter past. Can everyone hang on for another 10 minutes before we have a cup of coffee? Good. It's very important to ask. Right, now what we've done in that first component is we've made down the numbers that you should use to judge your business. They're not revenue and profit, they're cash flow and return. And you know how to calculate them, and you're also going to get a ready reckoner to help you calculate return, which is the hard route to cash flow, really pretty simple. Before we go any further, before we go into the part after the break where I'm going to start talking about what you could change in your business to be more valuable tomorrow, I just want to touch on a concept that is critically important for most businesses, which is the concept of strategic investment. The concept of spending money on something today, knowing full well it is not going to benefit the business till the future. It's actually quite interesting. We've already heard about one of the key strategic investments your industry body's making. You're launching a website, 1st of April, I believe. A lot of money would have gone into that website. And you've not seen a penny back yet, but you've decided strategically it's a good thing to spend the money because it'll make you stronger in the future. That's a J-curve. Now, everyone in this room will have J-curves, not necessarily to the same scale as that, but you'll all have J-curves where you've decided to spend money today and you're not going to get a benefit for the future. And I want to talk about those before we take our break. Now, what are J-curves? Let's give you some examples, some of which will be relevant to your industry, some won't. If you are launching a new type of service, has anybody in this room launched a new type of service of any sort in the last 10 years? Something you didn't used to do that you now do? Or you've basically been doing the same things year in, year out, week in, week out for 10 years? Okay, let's just say that that one doesn't apply. But what if the law changed tomorrow and you had to go away and learn something new about the law just to keep doing what you were doing? Then you'd have to invest time to be able to keep going, wouldn't you? Well, that would be a J-curve. Every time you change the way you interact with the market, building a website is a different way of interacting with the market. It costs a lot of money and you have to get a benefit. How many people here have got websites? Some of you. They would have cost money to build, I bet, because they don't give them away for nothing in my experience. Each time you buy a new photocopier, a new computer, a new car, you are buying a new piece of equipment to be more effective in the future. But you're having to pay for the whole lot up front, aren't you? Or at least fund it all up front. People, the most significant J-curve in almost all businesses. How many businesses in this room employ more than just one person, employ more than just yourself? Many of you. So all of those people who come to work for you are J-curves. See, there's this ridiculous rule. You've got to pay them from day one. What's with that? They might not be useful for 3 or 4 weeks or even months, but you've got to pay them from day one. So you're going to be going backwards, funding this until some point where they become valuable, then they leave. Oh, it's so oh, it's so every time you change the premises that you're in, maybe you take more office space or whatever, that's a J-curve. If you ever acquire someone, that's a very big J-curve. So these are all J-curves. And the reality is that the identification, the prioritization, and the management of those J-curves are going to become integral in you creating value in the future. The ROO measurement is going to be influenced by how well you manage J-curves. So, what I want to do is share with you a J-curve framework. Most businesses don't have a formal way of tracking J-curves, which is dangerous. I want to talk about the 3 phases of J-curve, the 5 rules of management, and then some other issues. Then we're going to take a quick coffee, then we're going to come back and we're going to spend the rest of the time talking a little bit about what we might want to change in our business to become more valuable. Okay, why are they called J-curves? Well, you're on this journey through time, and at some point you say, right, if I make this investment, I'm going to be stronger in the future. So you look up to the horizon and you go, I'm going to spend money today to be stronger tomorrow. But you know as well as I do that that money is going to be a step backwards to start off with in the hope of taking 2 steps forward tomorrow. And that's your J-curve. And as soon as we define it in that shape, it lends itself to 3 distinct phases. And you need to be able to identify the phases and behave differently depending on where you are in these phases. The first phase I'm going to call the investment phase. This has got 2 components to it. The first is, of course, the big check you write out to do something. But don't take your eye off the second component because it's dangerous and it's often hidden. I call it cash flow bleeding. Well after the big check's been written out, money's still dripping out through the cracks at a faster rate than this thing's paying you back. So you're still going down. Now let's hope that you get to the point of time where the bleeding slows to a point where more money's coming back in. So let's say over a month, as much as goes out comes back in. So it's no longer getting any worse. You're still cash flow negative over the life of the investment, but you are now at least catching up. And that's what the second phase is called, the catch-up phase. And over time, you catch up sufficiently that you get back everything that went out in phase 1, and you're now ahead. That is called blue sky. Now, most people, when they're tracking investments, measure this period of time to this period of time, and they call it the payback. Totally valid calculation, although, in my opinion, it's one-dimensional. And we prefer to not just think of this as time, but time and money. So it's not just how wide is the valley, it's how deep is the valley as well. We call this the risk zone. And let's talk about rules of managing the J-curves, and particularly how we manage the risk zone. First rule, try and limit the depth and the breadth of the valley. That's a very easy thing to say. But let me add something else to it, which unfortunately is really just an observation. Sadly, this observation is going to ring true with most of you. J-curves are almost inevitably deeper and wider than you initially think. In fact, in our experience, and we've tracked thousands of these through business, they're typically twice as deep and twice as wide. That's quite frightening, isn't it? Twice as deep, twice as wide. Tell me, has anyone in this room done any home renovations recently? Anyone ever done any home renovations? You have? Did they come in on time and on budget? No.
No.
Over time, over budget, J-curves. That's what happens. Now, the next rule. Do not become emotionally connected to your J-curve. This is, by the way, without a shadow of doubt, the hardest rule in any business, to not become emotionally connected to your J-curve. If your J-curve becomes a ski slope, that's what I call them, J-curves that don't turn, ski slopes. Or even if it becomes a flat liner, which is one that hurdles down here and then just never gets any better, you are exposed. And you'll have to have a point of time, in fact 2 points of time, where you say enough's enough. The first point of time, you're going to say, I am not going to put any more good money into this particular project. I might leave what's already in there alone, and if it can dig itself out of the hole, fantastic, but I'm not throwing any extra money at it. There'll be another point of time further down the ski slope where you say, I've had a gutful of this, I'm taking out whatever I can take out now, so if I don't take it out now, I'll lose the lot. Emotional arguments to help you pick emotional J-curve arguments. The first one, if you ever hear the word pet project, that's a dead giveaway. Here's another one you've probably heard of before, sunk costs. You're sitting around a table and someone says, we're a bit worried about this investment, I think we should exit. Someone else goes, oh, no, we can't. We spent 20 grand on this. We walk away now, we burn the lot. All I need is another 5,000 and everything will be okay. I promise you, if you're on the ski slope, the only conversation you're having 3 months later is, we can't exit this, we've spent 25,000 on it. It's an emotional argument, it's not good business. And then, of course, people. People. Emotional resources, people, aren't they? In fact, they're the only emotional resource. If any of you are sitting in your offices arguing with your computers or your telephone systems, you've got a problem, I can't help you. People are the emotion of business. So let me ask you all a question. Has anyone in this room, at any time in their career, ever worked with somebody who had a brilliant interview, brilliant resume, brilliant skills, but they didn't work out? Has that ever happened? Bad recruitment decision, we call it. Of course, it's happened to us all. One of the companies I did a turnaround on, by the way, was a recruitment company. Do we have anyone in the room who's worked in the recruitment industry before I say anything about the least professional group of people who walk the planet? Oh, seriously, what you see in that industry, these people would sell their grandmother if they could, twice in the same day. In fact, I was telling this exact same story. One of the people in the audience happened to be in the recruitment industry. He said, you don't understand, my grandmother's a hard worker. So I don't think you fully understand what I'm... Anyway, we saw so much evidence of recruitment failure in business that I actually had to track the 3 phases of recruitment failure. But before I do this, just make sure everyone understands what recruitment failure is. Because recruitment failure costs your businesses and businesses around the world millions or billions of dollars every day. There are 3 elements to recruitment failure. Most people only see one. First element of recruitment failure, you hire someone, you spend a lot of money training them, they don't work out and you fire them. That's happened to all of us at some stage in their lives. Second, everyone knows that element of recruitment failure. Second element of recruitment failure, you hire someone, you spend a lot of money training them and they fire you. Really annoying. But the third one is the one nobody ever picks. You hire someone, you spend a lot of money training them, they don't work out, and they don't leave. They just stay there. White hands in your culture. That's recruitment failure as well, by the way. So if I were to tell you that recruitment failure costs businesses millions of dollars a year, anyone want to has to guess the #1 reason for recruitment failure? Just a matter of interest.
Personality clashes?
Very close. It's actually cultural fit. It's not skill set, it's not the job description, it's their fit to your culture. Anyway, the point is that when I was turning around this recruitment company, I saw it happen time and time again. And the reason you see it happen time and time again is they can't test for cultural fit. They can test for skills, they can test for personality, but they can't test for cultural fit. So, ultimately what I observed, there are 3 phases of recruitment failure, and I gave them names. I thought, let's give them names, it'll make it a bit more fun. So the 3 phases of recruitment are called faith, hope, and charity. Faith, hope, and charity. Let me explain why. The faith stage starts on the date of the interview. Oh my word, this person's good. You have absolute faith. This is going to be the best person you've ever recruited in your life. And the faith stage goes right up to the date they start working for you. And then you go, they're not as good as I remember. And I hope it's going to be okay. A little bit about the elbow training. I hope it's going to be okay. And the hope phase will be as long for a while. Then one day you wake up with this horrible feeling in your gut and you say, they're never going to make it. No matter how much training I give them, they're never going to make it. But at that exact point, you fall into the trap that most people running a business fall into because you're busy. You procrastinate. You say something like, well, give them another month, they'll turn the corner. You know they're not going to turn the corner. You've just entered the charity phase. Faith, hope, and charity. Next time you're thinking about somebody in your business, work out where you are. If you have a ski slope in your business, you've got to do something about it, because if you don't, you'll destroy your business, I promise you. Rule number 3. Rule number 2 is the most difficult, and it is. Rule number 3, do not take on too many J-curves at once. Too many J-curves, especially if they're all sitting down here in phase 1, will simply suck too much cash out of your business. And I seriously do not care how brilliant the next idea you have. If it's the straw that breaks the camel's back, your business will stop. Major problem. Rule number 4. Have and push the plan to get it through phase 1, through phase 2, up into phase 3. Now there's no rocket science in that. But the interesting thing is that the skills on this side of the J-curve are typically innovation, proactive innovation, this side implementation. So the real question in your mind is, how well is the innovator handing over to the implementer? And if you think that's tough when they're different people, believe me, it's even tougher when it's the same person, as it will be in many of your businesses. Most of the development of IP in my business is done by me, and quite a lot of the implementation as well. And I prefer coming up with clever new ideas. I'd actually prefer to never have to actually go to work to do anything. I just like to come up with ideas. But I've got to force myself to take off my innovator hat and be an implementer, as you all have to as well. And that transition is tough. So challenge yourself. Are you the innovator, the implementer? How have you transitioned? And the last rule is to establish some sort of a register that you at least list these J-curves. So once a month you can challenge, are these J-curves working? Or have they stalled? Or have they become ski slopes? Because if they become ski slopes, you're going to have to do something about it. The cost of J-curves, if you get this thing wrong, they will kill your profit. They will kill your return. They will kill your cash flow. In other words, everything good about business can be destroyed with bad J-curve investments. But don't forget the other very serious cost of J-curves, the one that always gets forgotten, executive headspace. If you and your key people are trying to juggle too many balls at once, some or all of the balls are going to hit the ground. Now, the cost isn't all bad news. If you do this well, you'll build reserves. If you do it poorly, you'll lose potential. If you do it really badly, bankruptcy. Let's assume that it's not going to be that serious. This slide is the most popular slide generally of the entire day. But before I bring up a little tool that I've got to make sure we only take 10 minutes. Does anyone have any questions on anything so far? I think it must have been astonishingly clear if there are no questions. So that's good. Now, we're going to take a 10-minute break if that's all right with everyone. Now, in some environments, 10 minutes means 12 or 13 or more, but unfortunately we don't have that luxury today. So we're going to take 10. This is a tool called a clock. This is going to count from 10 down to 0. If you all give me permission, I will start talking again when it gets to 0. Deal?
Yes.
Good. It started, by the way.
Well, it's washing out.
Quickly, fair enough. I'm on the topic, right? Funny, you don't get to see the program.
No, not at all, not at all.
they're going to be in trouble.
Ooh, 30 seconds to go. Thirty seconds to go, everyone. Okay, so what we did in that first segment was in essence a couple of different things. First of all, we laid down some numbers to help you assess where your business is at. Is it a strong business, and how would you measure that? And we looked at the two key measures: is your cash flow healthy? Is your return healthy? And as I mentioned, there'll be a ready reckoner that we'll be touching on shortly that you'll get afterwards to do the root calculation, which is the more complicated of the two. But I'd like you to all be confident and familiar with how the cash flow calculation works. In the last half hour this afternoon, I'd like to share with you some ideas, if you like, of things that you might choose to challenge in your business in terms of changing your business. And one of the ways that you can assess what changes will be the most effective is a process called sensitivity analysis. So let me take you through what sensitivity analysis is. And I'll show you an example, and it's pretty close to an example based on your industry. So sensitivity analysis takes each of the 8 levers and changes them by 1%, holding everything else constant, to see which 1% change would have the most profound impact on creating value, creating cash flow, and creating profit. It's a mathematical process, but as a mathematical process, it's only really useful if it results in a change of behaviour and an action that's going to make your business stronger. We've done this now in well over 1,000 occasions, 1,000 different businesses, and in that 1,000 sensitivity analysis sample set, we saw some very strong common themes come up very early. And by the way, they weren't influenced by which industry you're in. These were common themes that sat across all businesses. The most powerful overriding common theme was that in more than 98% of the sample set, price was the most powerful driver of change. And please, please, please understand that this is a double-edged sword. So those businesses that were able to just inch their prices up, even if it was fractionally, they found that those 1% changes, or 2% changes, or 2.5% changes were the most powerful at making the business stronger. But on the other side of that double-edged sword, the businesses that were allowed to, or found that they were reducing their prices because of perhaps weak salespeople or being told that the market was collapsing, so we've got a discount, they were destroying their businesses the most quickly. Now, at the other end of the spectrum, one of the least sensitive drivers of change was costs, indirect costs. Now, I'd be surprised if either of those bullet points surprised anyone here, but I want you to read them in conjunction. And I want you to think about, what do businesses do when times get tough? Typically, the first thing they do is panic. They then drop their price, and they then try and cut costs to overcome the drop price. We've all seen that happen. 99% of businesses going into the recession did exactly that. But if I now tell you that what they are doing is abusing their most powerful driver and trying to compensate it with their least powerful driver, does anybody see a breach of logic? So for every 99% that did exactly that going into the recession, I can show you businesses around the world that did the opposite. When times got tough, they actually put the prices up, and everybody said, "You're nuts. Don't you realise there's a recession on, you'll lose business." Well, everybody lost business. They put their prices up and they spent more money on indirect costs, and they weathered the recession better because the work that they did, and they still got work because they were relationship-driven businesses, was better quality work. So please be aware of how powerful price is as a driver of your business, and I'd like to take you through a tool to help with that. This is an example of a sensitivity analysis. They'll look different for every business, but the order doesn't often change. So here are the things, or some of the things, that are key drivers of change in the business. And we model a 1% change on those based on a principle that economists call ceteris paribus. If I change this on its own and everything else is held constant, what's going to happen? Scientists do the same thing, by the way, when they do controlled experiments. I give a placebo drug to one and a real drug to the other, and I measure the difference between the two. Once we've modelled 1% changes of each of these things, we look at the impact on return, on cash, and on profit. And then we put the most powerful at the top of the list and the least powerful at the bottom. Now, there are lots of numbers on this particular analysis, but I'd like to pick out a couple. And by the way, this is done on a conveyancing practice, so it's very, very similar to your business. Might not be similar to your business in scale, but in order it will be. And I'd like to pick out a couple of numbers to create a conversation. If this particular business were to put its price up by 1%, and let's just talk about that for a second. Does anybody in this room think that if they put their price up by 1%, that anyone would even notice? Would the market even notice 1% change? I'd be pretty surprised if they did. Many of your customers are one-off customers that don't have an ability to continually check the pricing anyway. So a 1% change, I think, would have very little impact. But if this business put its price up by 1%, then it would generate 7% more return, and in this particular instance, $8,000 more profit. And this is a relatively small conveyancing practice. $8,000 more profit. And I would argue that the market would barely even notice. That's per percent. If this business worked 1% harder, in other words, it just did 1% more conveyancing services than it did last year, its return would go up by 1%, 1.6%, and it would earn an extra $2,000 in profit. Now you might be thinking, well, so what? Here's the so what. For this particular business, price is 4.75 times as powerful as volume. So for those of you who think you're going to get richer by doing more work, well, do more work, you'll get richer. It also work harder, by the way. But if you do exactly the same amount of work at a fractionally higher price, that will be 4.75 times as powerful for creating value. Does that make sense, everyone? Now, at this point in time, it's incredibly important that we mention to any ACCC members who may have snuck to this session that this is not in any respect price collusion across an industry body. It is merely pointing out the mathematics of price change. That's all it's doing. So, if pricing is the most powerful driver of change that you could affect, what are some of the things that you should be thinking about? Well, interestingly, in my experience, it's one of the areas where businesses are most reluctant to have the conversation. You're talking to somebody in your business about the possibility of putting prices up, and the very first thing you hear back is, we can't put prices up, we'll lose business. So that's the automatic response, and sometimes it's true, sometimes it's not. I suspect that a percent it wouldn't be true at all. But it is often one that's resisted by people within your business. A question I would like you to all ask yourself privately, without shouting it out, without admitting it to anyone else, how would you describe your price philosophy? And I'll tell you what, I'll give you a scale to compare this to. We'll use international examples. At one end of the scale, we'll put the international jeweler Tiffany's. You've all heard of Tiffany's, don't you? Who would like, in a very, very simple fashion, to describe Tiffany's price philosophy? What are Tiffany's thinking when they're setting their prices? One word. They're expensive. so expensive it hurts.
You just know that because you're a boy.
You don't understand what I was about to say to the other boy in the room. There's a small tip that if you go home,
I've been saying it before. There's a tab there you can arrange with price. You go from middle to the largest. There's like 3 pages of the first price.
the thing is, I think you're missing the point. This is a good time for you to be listening, not talking. Are you married?
No.
At the point where you get married, you take one of those little blue boxes home to your wife, and I promise you, you will be a hero for a week. Now, it should be longer than a week. The current exchange rates, one blue box for 1 week. Anyway, Tiffany's know when they set their prices up here, they're going to lose some customers. They know that. Most people are just going to walk past going, I'll walk down the road and get something very simple for half price. They know that. They also know that when somebody goes in and buys one of their products or their services, they'll get a big fat profit margin. So can we describe their philosophy as low volume, high margin? They're cool. Now let's go right down to the other end of the scale, to the largest retailer in the world today, which is Walmart. Of course, you've all heard of Walmart. Anyone heard of their catchphrase? We get variations of it here in Australia, actually. Low prices. Their focus is to keep dropping the price so far that they basically pick up every sale in the world. Last year, $476 billion. So they've got a few. So their philosophy is high volume, low margin. Now, do you all accept that Tiffany's and Walmart are successful companies? Good. So this scale that we're generating in our head is not a scale with a good end or a bad end, a right end or a wrong end. It's just a scale. You can be anywhere you want on this scale using the prices, as long as you follow a very important parameter of running business, and that is to match your product philosophy with your price philosophy. Plain English, do not sell a Tiffany's product at a Walmart price. It will not work. In fact, I'll go further. It's the #1 reason the company is underperforming or failing. If you're good at what you do, if you give a good service, be proud enough to say, I'm good at what I do and that's the price. If you want to go and get someone who's going to cut corners, someone who's not licensed, someone who's not going to do it properly, you can get it done for less, for sure. Your risk is just tripled, that's your decision. Be proud, if you're good at what you do, to put it out there and say, this is my price. And at the same time as understanding your philosophy, absolutely understand the mathematical reality of pricing. So I'm going to ask you all to do a breakout exercise. I want you to do it individually, or if you're here with someone you work with, is anyone here with anyone they work with? Or are you all individuals? You two work together? Three. So the two of you and you. Would you like to just switch seats for a second? Because I'm happy for you guys to do this together. Otherwise, do it on your own, because this is a very personal conversation you want to have with yourself about your pricing. You don't want to have to share this with anyone. So here's what I want you to do. I want you to think about a service that you offer. Let's say, can we say standalone conveyance service? Do you all know what that means? You've all got the same definition of that? This is what you don't have to tell each other. In fact, I'd prefer you didn't. How much do you charge for it? Just write it down and keep it to yourself. And where do you think that price sits in the marketplace? Are you the Tiffany's of conveyances, or are you the Walmart? You'll be somewhere. You'll get a bit of a feeling for what you are. And if you don't understand Tiffany's yet, it's going to be a tough question to answer. But anyway, just battle along, do as well as you can. Now, let us assume, for the sake of this discussion, that your contribution margin is 25%. It will be pretty close, and I don't want you stressing about what that is or what it isn't. It'll be pretty close, because I've looked at a lot of practices like yours, and that's about what it is. I want you to now contemplate that if you increased your price by 10%, and by the way, I'm not suggesting you do this, this is just an exercise. If you increase your price by 10%, you might lose some business, might you? What percentage of your business do you think you'd lose? If you're currently doing 1,000 a year, or 500 a year, or 100 a year, or what would be a reasonable number, Christine? Approximately.
50,
50 a year?
maybe at least 50 or 100.
Oh, no, don't answer the question. What would be, for a conveyancer, how many might they do a year? How many might they sell?
Let's use 1,000.
1,000, okay. Whatever your number is, if you had 1,000, you put your price up by 10%, what percentage of your 1,000 would simply say, I'm not going to use them anymore? What percentage would you lose because you're just too expensive? Write that number down. And then I'd like you to also contemplate somebody else saying to you, oh, I've got a way of you getting more business. Drop your prices. Let's go in there and cut our prices and win some more work. Because if you were charging less, you might pick up some more work, mightn't you? Write down that number. So just right now, answer those questions, either individually or as a group. Then I'm going to ask one of you to be super brave and share with us your answers. And if nobody wants to, I'm going to ask you to come up with a fictitious answer that nobody has to actually own up to.
Can I do that fictitious answer? Because I'm actually a mortgage broker.
Ah,
So.
well, write it down for your industry then. Yeah, I still want you
I don't
to.
charge fees.
So your fee is nothing.
Yeah, and my prices are set by the banks.
Okay. Well, this is a slightly different situation for you. Just take a break then. Go and have another coffee if you
I'm
want. Yeah.
doing this.
Excuse me, can I ask could be a really silly question.
There are no such things. I just had this argument with my 13-year-old son. There is no such thing as a silly question. Settle on, you don't know.
Yeah. Assume contribution margin of 25%.
Let's just assume. You don't have to answer that one.
What do you mean?
When you sell a service for $1,000, your variable costs to do that, including your salary, including searches, including everything associated with delivering it, might be $750. You might make $250 of profit. Okay, but let's just assume that's taken. I want you to focus on the other questions, not that. Okay, spend a couple of minutes on it, and then we're going to run one as an example. Kristen, What do you think? Or should I just ask you?
Yeah, sure, you can ask. So this is just what I think.
Okay, so 440 is the price. Tiffany's or what?
Well, you have to.
It's close to that.
Okay, okay. Okay, if that went up $143, so if that went up to...
Yeah, well, that's what I've done here, so that's...
Oh, okay, so it was 13.
Yeah.
If it went up to 1430, would you lose some business?
Yeah, I do.
What sort of percent?
I reckon about 8 to 10.
Okay. What if you dropped the price by 130 to, what's that, 1170? Do you think you'd gain some business?
Yes.
What do you reckon you'd gain? That's so?
Pretty close.
Okay. Just write down 10 either way, and if it's okay with you, use it as an example, unless anyone wants to volunteer their choice.
No worries.
You're not working together, you're not colluding. We're not colluding. Just in case the ACCC are watching, not colluding. How are we going? Actually work it out.
We can't, it's not just
Okay, well, that's all right.
But you're just guessing, aren't you? What
Yeah,
percentage
we're guessing.
are you going to lose?
That's your list.
That's a net guess.
Next.
Yes.
Yes, I think so. Oh, yeah, definitely.
Oh, you're going to know all our answers.
Well, I promise I won't tell anyone else. There we go.
how you're positioning yourself too, alright?
Okay, guys, let's just draw this together. Now, would anyone want to be the guinea pig? Because if not, I'm going to ask Kristen to share with us some numbers. Happy to do that if we just want to keep it nice and anonymous. And Kristen's not going to share her numbers. She's going to share what she thinks is about middle of the road for Darwin. Is that fair?
Yeah.
Should we go with that then? Yeah. Okay, Kristen, share with me. The product is a conveyancing service. How much per service?
The fee, 1,300.
1,300. And where do we think that sits between Tiffany's and Walmart?
A little bit closer to Tiffany's, probably.
Okay, fair enough. 25% contribution margin. How many would they be doing a year? How many services a year, maybe?
Let's say 800.
800 a year. Okay. Now, if you whack that price up to 1,430, do you think that this hypothetical business would lose some business? Would lose some of these 800?
8 to 10% probably.
10%?
Let's work on that.
Or they might lose 80 deals.
Yeah.
Now, what if they drop their price to 11,700, which is a drop of 10%? Do you think they gain some work?
11,700, we should be able to work there, or not work much. Sorry.
No.
Well, if your price was less,
1,170.
sorry, 1,170.
That's it.
Do you think if you were 10% cheaper, you'd get some more demand?
Yes.
How much?
Oh, let's keep it at 10.
10%.
Yeah.
In other words, another 80 deals that you weren't getting. Now, the reason that I've picked this hypothetical is, first of all, it's not giving anything away about anyone's personal business, but also I like it because it's actually a
Coffee break, let's go.
It's just outrageous what's going on here. I moved the flip chart. I moved the flip chart. Oh no. Hang on. We're back. That's all right, I'm under control. I know that probably sounds like I'm not, but I am. Okay, the reason I've used this example here, I like this example. Oh no. Oh no, Sherry's coming over now. I'm in trouble. I'll just inch this way a little bit. Sorry, Sherry. It was actually the flip charts for. Did you see what I moved?
I did. The flip chart had a vibration of some sort.
While Sherry's fixing that, I'll keep talking because I'm a better talker than I am a technical person, as you probably worked out. The reason I like this example is because it's fascinating. Wherever I ask this question around the world, to almost any industry, I get an answer similar to that. If I put my prices up, I'll lose a chunk. If I drop my prices, I'll gain a chunk. And furthermore, the salespeople of the organisation say, lose 80 deals, lose 10% of our market. You're nuts, aren't you? We can't do that. Or they'd say, but if I could pick up 10% volume, then I should be chasing after that. That's the normal sales concept. So I'd like to use some tables. And can you all do me a favour and not turn your notes yet? Don't turn your notes yet. So anyone who's got these things in front of them, turn them over. And I promise you'll get plenty of time to look at them later. I want to use some tables to check, to understand the mathematical reality of what would be happening to this business. The first table is titled The Impact of Price Increase. After a price increase, what percentage drop in unit sales will result in the same contribution margin in dollars? In other words, how many could you lose and actually be as well off as before the deal? And how we use these tables, and by the way, you're going to get a copy of these in full colour, not just the ones in your notes. How we use these is we find the contribution margin, and I suggest you use something like 25, although what you're about to learn is it'll make very little difference whether it's 20, 25 or 30. We come down to 10%, and we read across to this number here, 28.57. And what this number is telling us is that if the business has 25% contribution margin and puts their price up by 10%, if they lose exactly 28.57% of their business, they're as well off as before the change. Now, interestingly, Kristen told me that this business would lose 10%. So what I want to do, Kristen, is turn that answer into plain English. That business would do less work for more profit.
That's right.
Now, I normally expect a slightly more animated response than that. Now, I know there's a lot going on, so try again. Watching me, focusing, forget everything else. Less work, more profit.
Yes.
Let's have a look at another table, shall we? The second table is called the impact of price discounting, and this is going to tell us if we drop our prices, how many extra sales are we going to have to make to catch up? How many, just to get back to where we were? And if our margins are 25%, and we drop our price by 10%, we would need to do 66% more volume to catch up. So let me tell you, if you do 10% more work, let me tell you what's happening now. More work,
Yes.
less profit.
Increased costs and decreased sleep is what I wrote down.
And increased stress because you're having to deal with more things that could go wrong.
Are these figures based on averages that you?
Oh, no, these are based on something far more simple called mathematics. And allow me to prove to you, because some people look at these and they go, you've got to be kidding, right? What's he talking about? Some people say, oh, this wouldn't work for me, Nick. And I say, really? What planet are you from? The planet that doesn't use mathematics? Because last time, we all use it here. Now, let me tell you what will differ. What you wrote down will differ based on all of the variables of your world. What will not differ is the number you're comparing against. And if you don't believe me, let me prove the validity of these numbers using a very simple example. And I've deliberately, in case you're wondering, stood in front of the projector. This isn't some rookie speaker error that I'm doing. I'm deliberately going to get you to use your calculator that you all carry around with you between your ears. If you had your brain, if you had 20% margin in your service or your product, and you discounted by 10%, you're only discounting the price by 10, aren't you? But do you understand you're giving away half your profit? Anyone want to hazard a guess if you're giving away half your profit every time, how many extra you'd need to do to catch up? Twice as many. Logical, isn't it? Let's test it, shall we? 20%, 10%, twice as many. All this is mathematics. Now let me tell you what these tables don't tell us, then I'll tell you what they do tell us. First of all, never use them in isolation. Use them as part of a bigger conversation. What they're designed to do is stop somebody saying, can't put their prices up with lose business, and hope to end the conversation there. Because that's not where the conversation ends. The conversation should go on, well, would we lose business, and would we lose enough business to be behind, or should we be putting a bigger effort into explaining to people we do a good job, therefore we deserve this price? Secondly, please understand what we've just proven by mathematics. The numbers in the body of this report are not saying what would happen to your business. You've all written down what would happen to your business, knowing your business. You know your business better than I did. All I did was to say, use 25% contribution margin. What I hope you're now realising is it doesn't really matter what column you're using. The answer's pretty similar. All I did was to guide you. You then wrote down how much you'd gain or lose. Now let me tell you what these tables do tell us. They tell us that in the majority of circumstances, including very clearly your example, a price increase will make our business stronger, a price decrease will make it weaker. Now you all have to take that piece of information away on your own and make your own decisions, and you certainly can't collude with each other. Mathematics cannot be argued. Is that clear to everyone? Yeah. So what we do with those tables, or what I suggest you do, and I'm going to email a copy of these tables, full-size colour. You've got the little ones in your notes. I'm going to email you after today, have you come to this. One on one side, print them out, one on one side, one on the other, laminate them, and anybody in your business who's setting pricing should get one. Because these things don't lie. They will come from Cherry as an email afterwards with the last thing that I want to show you. And I know I'm very close to out of time, but I just want to very quickly show you something. And I'm nervous about showing you something because I've got to change the computer again. I'm going to give it a go. Anything could go wrong at this stage. If Cherry comes charging down the room again, I'll know I've done something wrong. Okay.
Oh, I've lost my screen.
We haven't, though. Hold on a second. Quite right. Don't just be plugging numbers in without the screen coming back. What do we need to do here, Sherry?
Right, what we need to do is go back to our presentation here, and then we choose a screen that we're going to be looking at, and it's this one here. Okay.
Lovely. Share.
And
Okay,
now I'll go back up there, and
everything will be okay.
hopefully.
Right. Guys, this is the other thing that you're going to have sent to you after today. And this is a ready reckoner that's basically put together to help you calculate ROO for your businesses. I understand that the ROO concept is probably new to many of you. So you heard it conceptually in the presentation. This will enable you to calculate it for your business. And I want to take you to the example column for the example. There are two tabs on the spreadsheet. One is an example so you can track through how it's working. The other one is a blank one so you can enter your own numbers. And the only numbers you enter are the numbers in white. Everything else gets done for you. But anyway, let's go to the example. Here is an example of a practice that has 3 conveyances. So very clearly put your number in there. Salary per conveyancer, 85,000. That was a guess, but does that sound about right for your marketplace? Maybe a bit less than that?
That's probably an average, really.
Okay, whatever it is for your business, put it in. I mean, you'll have the ability, this is just an example. How many settlements does each conveyancer do per year? We based it on 150. Your guys might be a bit more efficient, a bit less efficient, whatever. Is that a fair number?
No.
Is it too high, too low?
Too low.
Well, fantastic, even better. Pump it up! Well, as I say, this is merely an example. Then what you're going to do on the other sheet is put your actual numbers in. How many hours does it take to do each settlement?
God knows.
Ah, now you should know this, though, shouldn't you? Because this is what you do. If you don't know how long it takes to do each settlement, then I think you should go and find out. Well, I've got 8 in there, so that's remarkably convenient that that's industry average. So let's go with 8, shall we? Now, these next ones are all guesses, but you help me out. As I say, you don't use this one, you use the actual one. But what sort of disbursements in terms of searches do you guys typically have per settlement? Shall we put in 350? Oh no! Oh no! Numbers lock. Okay, good. Let's go with just leave it. I like the sound of that. Very fond of the just leave it option. Average inspection disbursements 1,200, conveyancer fee 1,200. So over here we were talking 1,300. So we're not too far off the mark. If you've got support staff to help the business, maybe they'd have a salary of around 55, probably. You might have some rent for your office, maybe 22. 35's kind of all the other costs associated with running a business, you know, put those in. These numbers at the bottom, at any point of time, how many assignments might be open? In other words, they've not been finalised, they've not been closed off and you haven't been paid. So you might have, say, 30 active at once. How long does it take from completion of the work to settlement? In other words, how long does it take for you to get paid? 30 days. I'm not going to touch it though, you'd have to overtype it. Actually, I might try and touch that one, but let's see what happens.
That completion of work when we get paid?
Yes.
It's the same day, isn't it?
Well, not necessarily.
We're talking about when we first get the instructions.
Open the file to finish of the file, is that what you're talking about?
Yep. And then this last one is how long do you take to pay for your disbursements? Do you get an invoice? Do you have credit to be able to pay them? If not, put 0. If you pay for those on the spot, put 0. If you've got a certain number of days to pay, put those in. And then the last number you put in is the value of fixed assets. So desks, computers, photocopiers, furniture, car maybe, I don't know. Anyway, those are the numbers that you put in. Then I want to show you what it's doing. First of all, it's doing a lot of calculations down here. Don't go anywhere near them, and definitely don't change anything. Over here, first of all, it's going to give you a basic P&L in a operating profit fashion. So the fees of this practice would be 1.192 million. Conveyancer costs 331. Other direct costs 625. Those are all calculations based on what you've told it in your data entry, meaning you'd have a contribution margin of 208. You've then got indirect costs bringing you down to operating profit of 96,500 or 8%. By the way, 8% is a nice number for your industry. If you can get your profitability above 8, I'm pleased about that. It's a good number. Over here, we've got the investment calculation. That is, do you remember I asked the question, how much money is invested in your business? If you answer all these other questions, it'll tell you. Work in progress, 54,000. Accounts receivable, 68. Fixed assets, 30. Accounts payable. Total investment in this business is $140,000 based on the information that you fed into it. Then the ROE calculation, well, we know what our revenue is. We know what our investment is. We know what our profit is. So now we know our leverage. Now we know our profitability, and it will now calculate ROE. It'll also, by the way, calculate percentage chargeable time fairness, but that's another issue, and total number of things settled. But basically, if you, in your industry, are running your business effectively, you should be generating a ROE in excess of 40%. You should be generating a ROE in excess of 40%. Now, answer me this question. Where else do you think you would get a 40% return on your money? Put it in the bank, do you think you get 40%? No, let me answer that question again properly. Where else legally would you get 40% return? Bank's not paying you 40%. Property market, even in Darwin, isn't going up 40%, and the stock market isn't. So what this is telling us is that if you run an effective business, you will get good return on the money you invest. Now that didn't do a cash flow calculation, but frankly it wouldn't be too hard to do, and you've all got the formula to do that. So what that business is a good business that is getting a good return and would have healthy cash flow. Now what if this business chose to increase its price? Oh, I'm really going to get myself in trouble now, aren't I? Why is this not working? Let's try it again. Oh, here we go. So at the moment its price is $1,200 per settlement. What would happen? If you were running this business, what if you put your price up to $1,250? Would anyone think that's worth a go? I wonder what would happen if you did. Watch the ROE calculation. It's currently 69. It would go to 83. And by the way, those of you who still get excited about profit, your profit goes from $96,500 to $119,000 through one tiny little price increase. Now, I'm not suggesting you put your prices up. I'm merely pointing out mathematics to you. So after today's session, you're going to get two things. You're going to get a soft copy of this that I want you to print out and laminate like this, and you're going to get this Ready Reckoner, which has got the example tab and then a blank tab. And the only thing you do is you put in numbers into the white cells. Everything else gets done. Okay? Okay. Sometimes people feel a little bit like this chap at the end of the workshop, but clearly I wouldn't expect that to be the case today. Thank you for the invitation. Sherry, Kristen, thank you for the invitation to come back to Darwin and do another session with your organisation. Thank you all for coming along and participating. Most of all, thank you for giving me another chance to talk about something that I'm passionate about.
Thanks, Nick. Thanks for your knowledge, insight and excitement about numbers. It's really refreshing. And if the CPCs just want to stay back, we can do that little presentation. Thank you again, Nick. That was wonderful.
My pleasure.
Oh, reminder everyone, the next seminar is on the 22nd of April. Fantastic.
Thank you. So I'll now send an email to Sherry with those two.
Did you touch it?
I didn't.